Picture this, a bustling exchange floor, traders shouting over each other, their eyes glued to flickering screens. You can almost feel the static electricity in the air, a storm brewing beneath the surface. Yet, amidst all this noise, few notice the quiet withdrawal of a cornerstone commodity, silver. It's like watching water slowly drain from a dam, the flow almost imperceptible until it becomes a deluge. In the realm of commodities, the term bank run typically conjures images of long lines outside failing financial institutions. But what happens when the run occurs silently in metal vaults? The scenario is breathtaking in its subtlety and potential for chaos. Investors, fearing the weakness of paper claims in a world increasingly yearning for tangible assets, start pulling silver from markets at an unprecedented rate. A subtle but deadly signal ignored by most, but seen clearly by the few insiders who understand its magnitude. Let's rewind through history, back to the 1970s, an era of oil shocks and inflation crises. Bank runs on commodity reserves weren't just speculative fantasies, they were stark realities. Just as the sight of emptying bank vaults once sent shudders through economies worldwide, today's massive withdrawal of silver from exchanges like COMEX is a harrowing echo with far-reaching implications. Jumping back to the present, the flight from paper to physical silver is more than a whisper. It's a roaring tide, leaving exchanges dangerously exposed. While mainstream media chatter fools the masses, painting optimistic pictures, it's only those with a discerning eye who recognize this as an indicator of impending market distress. Why is everyone running? Because they suspect, correctly, that a critical mass of demand is about to collide with an evaporating supply. In this volatile landscape, a new dynamic emerges. Bonds dare not break their silence, but tremble as the tectonic forces beneath them shift. Currencies, in a dance of perpetual devaluation, reflect the growing distrust of fiat, while precious metals gear up for a celestial leap. Silver isn't merely twitching, it's writhing, hinting at an imminent eruption. As the realization dawns, what seemed like a mundane statistic reveals its true form, the precursor to a systemic shakeup. Brace yourselves, the trigger has been pulled. Yet, with every seismic event, clarity emerges for those willing to look beyond the shadows. Chapter 2. A new high in silver prices. Imagine the scene. A stark, minimalist graph sprawled across the trading screens worldwide, tracing an almost vertical ascent. The line representing silver's value shoots upward like a rocket breaking the Earth's grip. The numbers beside it are no longer trivial. They are history in the making. Silver has crashed through the 102.97 barrier, a level once considered a distant dream. Yet, how did we get here? To comprehend this soaring ascent, we must dissect the anatomy of the beast, the COMEX vaults, the heart and nerve center of silver trading. Think of these vaults as subterranean caverns, colossal banks of metal whose ebb and flow dictate the pulse of global commerce. But now, they echo hollow. An extraordinary volume of silver is being pulled out, vanishing week after week. These unprecedented withdrawals feel like the pinpricks of a bubble about to burst, eroding the confidence in paper promises and sending shockwaves throughout financial markets. As the vaults bleed dry, something astonishing happens. The silver lease rates, the cost to lease this metal rather than owning it, skyrocket, reminiscent of stock market shorts, where borrowing costs become prohibitive. This leap in lease rates functions like an alarm screeching in a locked room. It signals severe distress and scarcity. Those rates are shouting one thing: supply is tight, razor thin. Above all, they reflect the growing possibility of a squeeze, a classic financial stranglehold where short sellers find themselves cornered. When markets confront such scarcity, they behave like a powder keg. The price of silver does more than just stretch its legs beyond $102. It's a mad sprint past multiple psychological and technical thresholds. Each tick upward is a crescendo, a symphony of new highs defying gravity and orthodoxy. Historically, markets have been privy to such meteoric rises before, the aftermath often marked by seismic shifts in economic landscapes. Take, for example, the turbulence of the 1980s when the Hunt brothers infamously attempted to corner the silver market. They found themselves trapped by their own ambitions and regulatory pushback. Yet today, the dynamics are different, shadowed by sophisticated algorithmic trading and the relentless march of global uncertainty. A scenario where regulatory bodies struggle to maintain equilibrium in increasingly decentralized and globalized financial arenas. Thus, the retreat into silver signals more than just investor anxiety. It's the expression of deeper distrust, of fiat, of failed monetary policies, of economic vulnerabilities exposed by geopolitical tremors. This price-breaking saga is not merely a record in the making. It is a narrative of tectonic shifts in economic power and market perception. The narrative now is not if silver will continue to rise, but how high it can climb before an inevitable recoil or the challenge of gravity takes hold. As the dust settles, new questions emerge. Who are the players behind the scenes, orchestrating moves as if on a grand chessboard, seeing moves ahead in an age-old game reborn? The system is under strain, and as silver sets its new records, the world poised on the brink watches with bated breath. In the world of finance, the term short squeeze evokes both dread and excitement, a term that speaks of desperate bids, soaring prices, and ultimately, financial havoc. Yet it's precisely this dangerous ballet we're witnessing right now, a silver short squeeze unfurling with an epic rush. The problem is fundamental. Too many promises, too few glimmers of pure metal to satisfy them. Short sellers, those who bet against the rise of silver prices, are feeling an acute sense of panic as the market defies their pessimism. Imagine a room rapidly filling with smoke. There's only one exit, and everyone inside realizes the real threat too late. The silver shorts, akin to those trapped gamblers, see their positions squeezed relentlessly as prices climb ever higher, ignited by scarcity and fear. When a short seller can't deliver the physical silver promised at a lower price and must buy at higher rates to cover these losses, chaos reigns supreme. Each upward price adjustment squeezes harder, throttling the lifeblood from those wagering against the rise. Looking back in time, the ghost of the Hunt brothers looms like a specter in this narrative. During the late 1970s and early 1980s, these Texas oil tycoons nearly cornered the market on silver, driving prices to unprecedented heights before crashing down. They played a reckless game of high stakes, caught between ambition and regulatory restrictions, leaving echoes still reverberating in financial history. Yet today's tableau is painted on a different canvas, one dominated by silent but overwhelming forces, nation-states and technology titans, entities with both the means and interest in shifting the balance of power through silver's tangible wealth. These modern juggernauts, sovereign powers seeking to shield against monetary collapse, and AI-driven megacorporations thirsty for silver's technological utility, are not mere spectators, but powerful players in this unfolding drama. State actors, notably from resource-hungry geopolitical rivals, accumulate precious metals not just as hedge, but as weapon, preparing for skirmishes on economic front lines. Meanwhile, the artificial intelligence sector, an industry whose roots seek the conductivity and purity only metals like silver can afford, is making calculated moves. They understand a simple truth. As digital realms expand, real assets bind our civilization to the physical world. Now, while we fixate on silver's monetary ascension, it's crucial to recognize the underlying tides at play. The shifts are suffused with intent and influence, and the strategies are played out in shadows, beyond the view of daily headlines. It's a stealth contest for dominance, where the resources dictate which giants will stand post-crumble of paper empires. Here, silver is more than a commodity. It's a linchpin, a chess piece in an elaborate game where both the East and West recalibrate their postures on the global board, each aware that control pivots not only on politics, but on those who master the physics of scarcity. Thus, as we decode the riddle of this silver squeeze, let's cast aside the noise surrounding rise and falls in price, and rather, observe with clarity those moves in the market's subterranean layers. For here, in the shadows, the stage for a broader confrontation is set, one where new laurels of financial stability or ruin will be crowned. The audience, composed of everyday investors, geopolitical strategists, and market veterans alike, understands this match's importance. The truth of today's drama is raw and unvarnished, a narrative that strengthens our appreciation of not just silver's worth, but of its role as a tactical asset of endurance and aspiration in an uncertain world. Greed is an insidious force, a whisper in the ear of even the most rational investor, promising riches just beyond the horizon. In today's silver market frenzy, this potent motivator is in full swing. As prices skyrocket, speculators and seasoned traders alike find themselves ensnared by the allure of rapidly climbing charts, where each uptick seems to shine with the gleam of untapped fortunes. The graph lines aren't just markers of financial valuation, they're siren songs, luring the market's participants deeper into the maelstrom of unprecedented highs. Yet just beneath the surface of this greed, fear pulses like a hidden current. It's the fear of those same graphs stagnating or worse, reversing and wiping away fortunes as swiftly as they accumulated. This dread is not unwarranted. Unlike physical silver, paper silver, contracts, derivatives, promises on paper can become worthless almost overnight. It's a spectacle we've seen before, and one where paper holdings can suddenly feel as ephemeral as smoke. Investors know, often too well, how quickly the floor can fall out beneath them, leading to sheer panic. In these chaotic markets, the emotional pendulum swings between greed and fear with alarming rapidity. One moment, there's the intoxicating rush of chasing gains. The next, a precipitous drop stokes existential dread. This volatile mix feeds the hysteria, creating an unpredictable, frenzied atmosphere where strategies are swiftly reevaluated in the face of new data or rumors. Each piece of news, each market whisper, can tip the balance, feeding either the momentum of greed or sparking the wildfire of panic on being trapped with paper assets. This continual cycle of greed meeting fear is underscored by fundamental shifts in perception. As participants confront the dual nature of silver's markets, they are forced to question the reliability of their holdings, fostering a climate of urgent reevaluation. It's this very dynamic that transforms an ordinary market day into a breathtaking spectacle, a psychic battlefield where every move feels fraught with profound implications. In understanding these emotional drivers, we unveil a crucial element of any financial crisis or boom: human psychology. Silver's recent trajectory isn't solely guided by economic principles or geopolitical tensions. It's also a mirror reflecting the hopes and anxieties of those who invest in it, those who shape its narrative with their beliefs and actions. As greed and fear wrestle for dominance, they inadvertently chart a course that history will either mark as visionary triumph or a cautionary tale of hubris. Thus, in the silver market saga electrifying 2026, human emotion plays its timeless role, a crucial heartbeat beneath the cold calculations of economic theory. The landscape is as much shaped by this internal tempest as by external market forces, reminding us that even in worlds dominated by data and tech, at the heart of finance lies the unpredictability of the human spirit. The silver market has erupted into a frenzy, rewriting the narrative of financial dynamics on a global scale. We stand at the threshold of a paradigm shift that could redefine the economic landscape and the very role of precious metals like silver. Historically viewed as gold's junior brother, silver is stepping into the spotlight, finally recognized not just as a secondary hedge, but as a leader in its own right. Financial history in the making. This shift is not merely anecdotal but foundational, echoing periods of monumental change seen throughout economic history. Consider the turbulence of the 1970s, when silver moved from a forgotten relic to a strategic asset during crises of currency and confidence, or the disorienting chaos of 2008, when financial systems were exposed for their vulnerabilities, rekindling interest in tangible assets. Today, we are witnessing a similar inflection point, one where silver appears poised to assert its importance in ways the market hasn't seen in decades, or perhaps ever. Re-evaluating precious metals. The essence of this transformation lies in a comprehensive re-evaluation of precious metals' global role. For too long, the market relegated silver to industrial applications or secondary investment mechanisms. However, the current environment has seen a seismic shift in perception. Investors, shaken by fiat uncertainties and digital proliferation, are revisiting tangible assets with renewed vigor. This reevaluation is driven by three main factors: scarcity, strategic necessity, and the digital economy's reliance on real-world materials. Silver is critically important for emerging technologies, from solar panels to electronics, underscoring its vital role in both global development and geopolitical positioning. As demand outstrips supply and industrial needs collide with investment appetites, silver breaks free from its traditional confines, becoming a cornerstone of future growth strategies. From junior brother to market leader. Yet, the most compelling aspect of silver's ascension is its transition from playing the second fiddle to becoming the market leader. Historically, gold commanded attention as the ultimate store of value, but silver's versatility, the soldier on technology's front lines, a barometer for inflation, and a hedge against currency devaluation, reframes its market position. This transformation echoes a broader shift in financial thinking. Traditional asset classifications are blurred as new parameters define value and risk. Silver is no longer merely a commodity to be traded, but emerges as a strategic asset, fundamental to navigating the complexities of today's macroeconomic terrain. The newfound recognition of silver as a pivotal player underlines a broader reorientation, where investors recalibrate their portfolios to include this once overlooked metal as a primary component of future-proof investment strategies. Thus, as we witness silver's elevation in the market hierarchy, the implications are profound, signaling a departure from orthodox financial paradigms towards a future where precious metals are not just insurance against volatility, but active contributors to economic stability and growth. This paradigm shift will likely be remembered as a defining chapter in financial history, reshaping how we value and interact with the physical world in our increasingly digital age. Silver's price dynamics. A 48-hour storm. In the turbulent waters of the silver market, The price action over a mere 48-hour period unfolded like a classic financial thriller, leaving investors on the edge. The traditional resistance models that traders swore by crumbled under the immense pressure of frenzied buying and speculation. Imagine a dam built decades ago, holding back a roaring river, yet suddenly finding its ancient walls pulverized by forces it was never designed to withstand. That's what happened when silver shot past previously formidable resistance levels, leaving armchair analysts and tenured strategists alike scrambling to make sense of the chaos. Every tick up in price sent electrical shocks through institutional floors, prompting panicked phone calls and hastily convened meetings. The surge was not a gradual climb, but an explosion, obliterating expectations as it soared. This wasn't just trading, it was a battle for liquidity, each tick pointing to a broader struggle within the financial ecosystem. Hedge funds and central banks alike grappled with a tightening liquidity squeeze, the kind that makes the financial world's breath catch and markets pause in anticipation. The break from traditional resistance models. We've entered an era where the old paradigms no longer apply. As if caught in the grip of an invisible force, silver shattered barriers that once seemed impenetrable. Imagine an orchestra where each note is supposed to follow the last, its harmony disrupted as if a rogue conductor upended the score. This scenario forced a monumental rethink, suggesting that the market for silver was operating under new rules, perhaps governed less by historical data and more by an intricate web of geopolitical tensions, industrial demand, and speculative fervor. Traders, grasping their outdated charts, quickly realized that conventional technical indicators were rendered obsolete, akin to maps of a territory reshaped by unknown tectonic forces. The break from these models signals a fundamental misalignment between past assumptions and present realities, where silver's price action serves as a stark reminder of the market's unpredictable nature. Institutional struggle for liquidity. As prices soared, a parallel narrative unfolded behind closed doors. A ruthless scramble for liquidity. The once fluid markets thickened like quicksand. Institutions found themselves in a dreaded vice grip. It's one thing to anticipate swings, quite another to find oneself trapped with no clear exit. Balance sheets began to creak under the weight of margin calls, and the silence of trading floors was pierced by urgent whispers and frantic keyboard taps. This liquidity challenge wasn't merely an operational hurdle. It was symptomatic of deeper structural tensions within the global financial architecture. The competition for liquidity became a high-stakes game, with every move scrutinized by counterparts and rivals aware that one misstep could cascade into catastrophic market-wide implications. As the financial world holds its collective breath, the silver market appears not just as a bellwether, but a catalyst, not just as a commodity, but a critical juncture at which the very tenets of market interaction are rewritten. We find ourselves in an era where liquidity is not a given, but a precious resource fought over in the trenches of financial warfare, signifying an unfolding narrative that reverberates far beyond the glittering confines of metals markets. The U.S. ultimatum to Denmark. As silver markets teeter on the edge of new realities, an unseen drama unfolds on the geopolitical stage. The United States, a titan in global politics, issued an ultimatum to Denmark, a move that would ripple across NATO's carefully crafted alliances. This diplomatic maneuver, cloaked in the language of strategic necessity, unveils deep strategic interests, particularly regarding Greenland's untapped resources, a treasure trove of critical minerals, including precious metals, that could recalibrate power dynamics. This ultimatum isn't just a political gambit. It's a chess move with economic implications that resonate through financial markets. The U.S., eyeing Greenland's potential, understands that control over these resources confers not just economic leverage, but geopolitical clout. It's a resource race akin to a modern-day scramble for Africa, with precious resources replacing gold and diamonds as the coveted prize. Potential NATO fragmentation. The ultimatum's reverberations don't stop at economics. It stirs the deep, turbulent waters of NATO, an alliance crucial to Western unity. This act, perceived by some members as unilateral and aggressive, has the potential to fray the alliance's fabric, leading to fragmentation as smaller states reassess their allegiances. The delicate balance of trust within NATO faces a significant test, with each member state weighing loyalty against national interest. Market participants, attuned to this geopolitical ballet, understand that NATO's cohesion underpins European stability. Any fissures within the alliance could signal broader instability, prompting a flight to safe haven assets, a flight where silver, unlike before, leads the charge. Market implications of geopolitical tensions. Geopolitical tensions serve as a seismic force in the financial world, and this US-Denmark episode exemplifies how political tectonics can reshape global markets. Precious metals, long considered barometers of uncertainty, find themselves in heightened demand as risk perceptions escalate. Traders, investors, and institutions pivot swiftly, seeking refuge in assets that promise value amidst volatile crosswinds. The silver market, already electrified by its intrinsic supply-demand dynamics, now faces additional pressures from global political discord. The interplay between geopolitical gambits and market sentiment amplifies volatility, pushing prices into uncharted territory. Risk models, built on more stable times, are tested to their limits as investors grapple with scenarios that present both peril and opportunity. In essence, what we witness is not just a singular geopolitical event, but a catalyst that could redefine alliances and economic landscapes. A pivotal moment where markets serve as both battleground and barometer, capturing the invisible but palpable tension threading through global narratives. Weak U.S. macroeconomic indicators. Amidst geopolitical tensions, we turn our gaze to the trembling foundation of the U.S. economy. The once mighty dollar, historically perceived as a safe harbor, now shows signs of erosion. Muddled under unrelenting pressure, both internal and external, the U.S. economic indicators portray a landscape teetering on the edge. Unlike the robust growth seen in post-recession recoveries, the current period is marked by tepid advances and conspicuous vulnerabilities. Highlighting the dashboard of economic indicators, one cannot ignore the sagging performance of gross domestic product, GDP, expansion. What should be a robust engine is now sputtering, with growth rates failing to meet expectations in quarterly assessments. Embedded within these figures is a story of industrial slowdown, hampered exports, and diminished business investments, all shadowed by a rising specter of protectionism. Recession signals and dollar weakness. The recessionary clouds forming over the economic landscape are not mere figments of pessimistic imagination. They are discernible patterns emerging from the cracks in the data. As inflation sprints ahead of wage growth, consumer sentiment dips, signaling a potential downturn. The juxtaposition of persistent inflation alongside slowing economic growth is a harbinger of stagflation, echoing the 1970s economic malaise. Concurrently, the dollar's former invincibility is being rigorously tested. Once the undisputed king of currencies, the greenback now faces depreciation pressures, compounded by fiscal deficits and a burgeoning debt ceiling. A weak dollar, while potentially spurring exports, erodes purchasing power and elevates import costs, a double-edged sword in the delicate balance of international trade. Impact of disappointing PMI figures. The Purchasing Managers' Index, PMI, a forward-looking indicator critical to gauging economic health, heralds troubling news. The manufacturing sector, long perceived as the backbone of American economic might, shows contraction. As the PMI dips below the equilibrium threshold of 50, alarm bells ring across financial markets. The readout, a reflection of plummeting new orders, thinning export pipelines, and dwindling inventory buildup, underscores an industrial lethargy. This underwhelming industrial activity resonates beyond numerical representation, painting a vivid picture of a supply chain beleaguered by bottlenecks, labor shortages, and unpredictable trade policy shifts. In lockstep, the service sector PMI mirrors a companion play, struggling under the weight of consumer reticence and service price escalation. Against this backdrop, the financial markets brace themselves. Bonds awaken to these tremors as yields react with whipsaw volatility, a dance between the pull of safe haven capital flows and the push from inflationary pressures. Currencies oscillate as traders reassess relative strength and fiscal postures. Precious metals, including the aforementioned silver, become refuges for capital seeking solace from the tempestuous seas of economic uncertainty. In summary, the U.S. macroeconomic indicators, when scrutinized under the macro lens, reveal an economy grappling with multi-pronged existential challenges. Declining growth prospects, coupled with a faltering currency and underperforming industry, compose a narrative worthy of profound introspection and strategic recalibration. For market participants, these signals necessitate strategic adaptability, emphasizing diversification and hedging against turbulent macroeconomic winds.